The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to welcome two of my good buddies to the Rebel Capitalist Show. We got Brent Johnson and Peter Schiff. This is going to be an incredible interview. Peter called me the other day and he said, hey, we got to do another debate style format with our good friend Brent Johnson on the dollar. Brent Johnson is notorious for his bullish position, and Peter, obviously, a very bearish view for the dollar. And so we set this up to where we can go back and forth and just really talk this through to help the viewers and the listeners better understand each person's position. So I want to, before we get into it, guys, I want to make sure that we kind of define what we're talking about. So when we're discussing the dollar today, I think we're really going to be talking about the DXY. Is that what you wanted to discuss, Peter? Really, the dollar against other fiat currencies?
Yeah, I mean, not necessarily just the ones that are in the dollar index, because some of those currencies also have their own problems. But yeah, I do think that the dollar's problems will rise to a much greater degree than what you'll see, in Europe and Japan and the UK and some of these other countries that are in the dollar index. So yeah, I think the dollar is going to go down against the dollar index. I think it may go down more against currencies that are not in that index. And it will certainly go down more against gold. I believe all the currencies in the world are going to lose absolute purchasing power, and you'll be able to measure that in gold. But when it comes to how much they lose relative to one another, fiat currencies, they all sink. It's just a question of at what rate. And I do think the dollar will ultimately sink faster than most of the other currencies, maybe even all the other currencies in the world, at least for a time.
So I think Brent might even agree with you on gold there, but what's your time frame for the dollar losing value against these other currencies? Is that like a 6-month time frame or a 5-year, 10-year? What do you think?
Well, I think it's not going to be anywhere near 5 or 10 years. 6 months may be more accurate. It's hard to say, but the dollar may have topped already. The dollar index got above 105 about a week ago. And now it's back down
101.
Below 102. It's like 101 and change. So maybe about a 4% pullback in a pretty short period of time. So we'll see what happens. But, what I think it's going to take for the dollar to really sell off is either one or two things are going to have to happen. Either the Fed is going to have to come clean and admit that the U.S. economy is not as strong as it thought, and therefore it's not going to be able to be as aggressive as it claimed when it comes to inflation fighting. And it may even try to say that the weakness in the economy means that we don't have to fight as hard because inflation is simply going to come down as a function of the weakening economy, because Powell kept saying that, the economy is super hot, it's overheating, and it's this red hot economy that is causing inflation. Now, that's not true, but that's what the Fed claims. And so the Fed will have at least an excuse initially to adopt a less hawkish or more dovish, forward guidance in the face of all this mounting evidence that the economy is either headed to a recession or already in a recession. So either that's going to happen, the Fed comes clean, or the markets begin to front run that, capitulation and start to realize that that's going to happen. Even before the Fed acknowledge it, the markets start to realize, wait a minute, this economy is a mess. We're in recession, or we're going to soon be in recession. So the Fed is never going to be able to follow through with the rate hikes that have already been baked into this cake. And I think the reason that we've seen this strength in the dollar is because everybody has been bracing for, this epic inflation battle where the Fed was going to, go Paul Volcker on inflation and the consequences be damned. Who cares? We're gonna put this inflation genie back in the bottle. We're gonna go back down to 2%. And so just the way the markets believed the Fed when the Fed said there was no inflation. In fact, they said there wasn't enough inflation. And then when they said, oh, don't worry about the rise, it's transitory. Now that they've admitted it wasn't transitory, the markets still believe the Fed. For some reason, the Fed credibility is still there. and the markets believe the Fed is committed to fighting inflation. Well, I don't. I think they're going to give up that fight the minute they realize how weak the economy is, because I think all of their tough talk is predicated on the economy being strong enough to withstand the rate hikes or the quantitative tightening. But when they realize that's not the case, they're going to reverse. And so either the Fed is going to tell that to the markets, or the markets are going to figure it out. And that's when the dollar really starts to fall. But what I think is the nail in the dollar's coffin is when the Fed turns its attention to the economy and starts to stimulate the economy, even though inflation has not returned to 2%. And in fact, I believe that the next recession will be a catalyst for an acceleration of inflation as the Fed prints more money to try to prop up the economy. And we're going to get the economy falling at the same time inflation is rising. And that means unemployment is also going to be picking up dramatically. You know, the Powell was talking about how he had this great labor market, the greatest he's ever seen. That's a great contrarian indicator that the labor market is about to fall out of bed, and we're about to see a big problem. Just like, you know, when Biden was bragging about how the ruble was becoming rubble and it was collapsing. All you had to do is buy rubles if you could find a brokerage firm that would let you do it, because that was like the bottom, and the ruble has gone straight up ever since Biden, you know, basically wrote its obituary. So I think the same thing with the Fed. They think this labor market is so strong, it's an accident waiting to happen. And so when we get that, when we get recession and rising inflation at the same time, maybe in unemployment and inflation both go into the double digits. 10% unemployment, 10% inflation. When the markets get a whiff of that, I mean, that's it. I mean, the dollar is going to get killed in that type of economic environment.
Yeah. So I think what's fascinating here is, Brent, I imagine you agree with pretty much everything Peter said, except you believe that the dollar will do the opposite. So maybe explain your position.
Yeah. I mean, there's a lot of stuff I do agree with Peter on. And, you know, I'm a big believer in gold. I think everybody should have gold in their portfolio. I think he's right. I think in the years ahead, gold will probably outperform most fiat currencies, if not all fiat currencies. I think it will outperform the dollar. I guess the one that will keep up the most, I think, is the dollar versus gold. And it may even be a headwind for gold in the short term. It already has been this year. You know, you look year to date, the dollar's up 5-6% year to date, and gold is down year to date. Or it's up slightly. Sorry, maybe it's up 1 or 2% year to date. Since the invasion of Russia, dollar's up 5 or 6%, and gold's down 5 or 6%. So, you know, the dollar's held up very well this year. I think Peter's right. It has been on the strength of the expected rate hikes. I think it's unlikely they get to hike as many times as the Fed would like to hike. That said, I think that they're going to hike until something in the credit markets break. I don't think they care what asset prices do. I don't think they care if the Dow's at 30,000 or 25,000, as long as the credit markets are still holding up. And so far they are. Despite the volatility we've had this year, it's still in the mid 20s. It's not crazy. High yield has held up fairly well. Credit spreads have started to widen a little bit, but they haven't totally, you know, broken. They're not having any trouble funding the Treasury. But you can't say that same thing for other countries around the world. You know, again, this is a relative game. And despite all the problems that Peter has pointed out, which I tend to agree with if I'm analyzing the United States in isolation, it's not an isolated world. It's a global world, and everything trades relative to each other. And I think Europe has extreme problems. I don't think the ECB is going to be raising rates anytime soon. And if they do, it'll be even more short-lived than the rate hikes that the United States is doing. Japan has already committed to buying however many bonds they have to do in order to keep interest rates low. Interest rates went up 25 basis points in Japan, and they completely lost their minds, right? And they're providing however many yen are necessary to keep the interest rates low. And so you've seen like a 20% move in the yen. I mean, that's a major move in a major currency. And it's for all the reasons that I've tried to point out, is that every other country, or most other countries, are in the same situation that we are. We're not doing this in isolation. And I think everybody else is going to have to. I don't think there's a situation where the US goes into a recession and we have to react to it, and everything stays fine in the rest of the world and they don't need to react to it.
Right.
So, if that was the case, if the US was going into the recession while the rest of the world was in good shape, then I'd probably agree with Peter. But I don't think that's the case.
Yeah, right. So that makes a lot of sense. So domestically, you totally agree with Peter. It's just you think that other countries will have to do more of what the United States has to do, and therefore, in a relative game, dollar goes up. Peter, what do you think about that?
Well, I mean, I think a lot of the developed world, if you're talking about Europe and Japan, where you have, this type of debt situation, although at least in Japan, I mean, they're still a creditor nation. Europe as a whole, if you look at all the European community combined, it's a net creditor, and Europe and Japan have trade surpluses. So they're in different situations than the United States. But what they share with the United States is they have enormous debt relative to the size of their economies. And both of these countries are going to have to deal with a lot of disruptions when that debt service becomes, too big a burden on their economies. I mean, right now, Japan is trying to fight that. But, for years, Japan got away, and to an extent, Europe too. The artificially low interest rates were supposedly a cure to the non-existent problem of there not being enough inflation. That's what they were always hiding behind. Go back to Abenomics and all this nonsense. Japan's inflation rate is too low. That's the problem that this monetary policy is designed to solve. Well, after several years of extremely high inflation, which is going to happen. I mean, inflation is not just temporarily here. We've been having inflation for better than a decade. It's called quantitative easing. It's not like it just showed up out of left field. It just initially showed up more in asset prices. But the entire time I was warning that eventually it would end up in consumer good prices, and that's where it's going to stay. And so we're going to be looking at extremely high rates of inflation for many, many years. This is not going away. This is here permanently. And so at some point, the Japanese electorate, Europeans, there is going to be a big push. We can't live with this kind of inflation. Something has to be done. And so at that point, they do have to make a decision. Are they going to have, runaway inflation, or are they going to let rates go up, shrink money supply, and deal with that problem? Bankruptcies, and all that would be healthy, because you have a lot of companies that should go out of business that are being propped up. I mean, economies are misallocated. There's a lot of problems that governments create when they create inflation and artificially suppress interest rates. And so those problems need to be resolved. But I just think that the United States is in a worse position to try to deal with the alternative of fighting inflation, given the nature of our economy, this huge bubble service sector economy that's built on deficit spending and trade deficits, budget deficits, a service sector economy that's predicated on the rest of the world supplying us with the goods that we can't produce. And I do think that one of the things that's going to change with this massive inflation is I do believe there is going to be a new economic order. I think that the economies of the world are going to recognize that the system we have now, where everybody's fiat currency is backed by another fiat currency, is going to come to an end. I mean, just like, you saw they tried to back that stable coin, what was it, Terra Luna. Yeah, they said it was stable, but it wasn't backed by anything but some other crypto. So what was backing that crypto? Nothing. So you have dollars, euros backed by dollars. Well, what backs the dollar? Nothing. So it doesn't work. So I do think that we're going to go back to an economic order where gold is the primary reserve asset, and the euro is backed by gold, the yen is backed by gold, the dollar. Those are the primary reserves. Everybody has an asset, a monetary asset that isn't somebody else's liability, and no one has this exorbitant privilege of being able to create a reserve currency out of thin air and just live off the productivity of everybody else. But when we make that transition, the United States is the least able to withstand it, because we have been the primary beneficiary of the economic order that we have today. And when that changes and the United States can no longer do this, when we have to go back to a saving production economy where we can't consume unless we produce, and nobody can borrow unless somebody else saves, that is a major transition. And I don't even see how we undertake it, especially in the political environment that we're in, the popularity of big government and socialism, how we're going to dismantle enough government to even allow this to happen. And now when you have so many people demanding, oh, we want less inflation, they don't realize that that's impossible unless we have less government, because inflation is how we're paying for government. And so the only way to let the middle class off the hook on inflation is to let them off the hook on government, which means we have to slash Social Security, Medicare, Obamacare, defense. No one's willing to do that. Alternatively, they can dramatically raise taxes on the middle class. No one's going to do that either. So we just have this unique problem, I think the severity of it, that I think the dollar just has a profound decline. But, I think the emerging economies are going to end up in a much better shape. The ones that have been more productive and have saved more and produced more and exported more, I think, they're in much better position than the advanced economies to come out, really, really winners on the other side of this.
Right. So it's interesting because if we're sizing the countries up as like two football teams or basketball teams, I guess it's the NBA finals time right now, you're just looking at strengths and weaknesses. And it sounds like, from Peter's position, the strength of Japan and Europe is that they produce more than they consume. And then that the strength of the United States is the dollar is the reserve currency. So it comes down to an argument of which one is going to win out, is going to actually win the game. Which strength is going to prevail in the short term? Because I think in the long term, both of you would agree that all fiat currencies will go down, and you're going to have to, we'll call it, reset the system, and it most likely will be backed by gold or something that people have confidence in. So do you see the argument kind of distilled down to that level, Brent, where it's just about produce, consume, or dollar reserve currency?
Well, I think there's more to the argument than that. Again, I don't disagree to the argument that Peter is making if we lived in a free market. If we lived in a free market, Peter does a great job of explaining the fundamentals and why things would play out that way. But we don't live in a free market. We just don't. And so Peter hasn't talked anything about the military aspect of the United States and their ability to enforce their will on some of these smaller countries. Now, maybe they can't enforce their will on countries as easily like China or Russia or some of the other big major countries, but some of these smaller emerging market countries who currently rely on the United States to export their surpluses into and who have huge dollar debts need dollar funding to keep operating until that new reset system comes about. And until that new reset system comes about, they're hooked on the dollar. They might not like it, but they are. They're just like a junkie on heroin. They can't get away from the dollar. That's what they use. The other thing I would say is a lot of these surplus markets that Peter talks about, I agree, they do have surplus markets. But the reason they have surplus markets is there's two big markets that they sell into. One of them is China, and the other one's the United States. And the United States is either every other country's number one or number two biggest client. I don't know which one, but they're one of the two. And I don't know too many businesses that can survive if they lose their one or two biggest clients, or without having severe impairment, right? And so we already know China has trouble. They're having to ease monetary conditions already because they've got gross malinvestment. They've got huge real estate bubble. They're no longer getting dollars. The dollars that can leave are leaving. There's political unrest between these two different warring factions in China. Xi is still in control, but he's starting to be challenged. And so, they can probably not buy as much as, if they go into a recession, they're not going to be able to buy as much as these surplus countries' goods. If we go into a bigger recession, we're not going to be able to buy any of these, these surplus goods. And so those countries that are selling those surplus goods are not going to be selling them, and they're not going to have the surpluses to the extent that they have now. And all those countries have huge debts. So they are not going to go, like I said, there's not going to be a situation where the United States goes into a massive recession and the rest of the world is fine. That's just not going to happen. Yeah. We can all go up together. We can all go down together, but there's not a situation where we go down on the teeter-totter and everybody else goes up.
Yeah. Okay, well, Peter, go ahead.
Yeah. So here's what you have to look at. So if there is a huge recession if the US dollar goes down during that recession, I agree with you. If the US dollar goes up during a big US recession, that's probably going to be very problematic for the rest of the world. But if
Why
the
would
US
it go down?
Well, because we're printing a bunch of money in a recession, and we have bigger, the government steps.
But so is everybody else.
No,
But
but
so is everybody else.
let me just finish. With the U.S. recession, right? The dollar tanks because our budget deficits now go to like 6 trillion, 7 trillion. The Fed's balance sheet is 20 trillion. I don't know where it's going in the next round of quantitative easing, but the dollar goes down a lot. And as that happens, number one, you talk about a lot of these emerging markets that have a lot of debt. A lot of that debt is in U.S. dollars. And as the U.S. dollar falls, a lot of that debt is basically, forgiven. It's gone because in terms of their local currencies, it's now a much smaller amount that they owe. And so it provides tremendous relief for these economies. And, you mentioned that America, we're the biggest customer for a lot of these countries. We are, but we're not a good customer. We're just a big customer because these countries have to loan us the money to buy their stuff. So they're vendor financing us. And if we can't ever pay that money back, we're not a good customer. We're a deadbeat customer. They're throwing good money after bad. They need to cut us off because we can't actually pay. All we can do is forever issue IOUs. And so when all of these countries stop exporting to America, they are not worse off. They are immediately better off because they get to keep all of their stuff. Now, the key is to be able to produce the stuff. So let's say you have some country that's been producing all this stuff and then shipping it to America. And now Americans get all that stuff and we just give them little pieces of paper. And so America has all this stuff and our trading partner has these dollars, which is just paper, can just hold on to maybe buy treasuries with them. But Americans get to enjoy all this stuff. Now, let's say all of a sudden the dollar crashes and now this country doesn't sell us its stuff anymore. The stuff stays there. Well, somebody in that country is going to buy that stuff. They're not going to just, drop it into the bottom of the Pacific Ocean. The stuff's going to get sold. It's just that it's going to be somebody in that country that's going to get it instead of someone in America. Now, the people in America that used to get all this stuff, we're not going to get that stuff anymore. We're just going to have our dollars. But what are we going to buy with those dollars? Nothing, because they don't have any value. So I would rather have a bunch of stuff that I can use that makes my life better than more paper that I can't use and doesn't do anything to make my life better. I mean, the countries that get to keep their stuff are going to be in much better shape than America that gets to keep its worthless paper. And, that is the ultimate reason.
Let's talk about the stuff. Look, so again, from a fundamental perspective, I don't necessarily disagree. But let's talk about the stuff that we import, and then let's talk about the stuff that we export. Mm-hmm. We import iPads, and we import clothing, and we import Louis Vuitton purses. But we export to the rest of the world food and fresh water and protection, okay? So let's pretend that let's say everybody just isolates. Everybody keeps what they produce at home, and we no longer feed the rest of the world, and we no longer give fresh water to the rest of the world. And we no longer protect the sea lanes on the other side of the world. We can self-sustain ourselves better than many countries around the world can self-sustain themselves. Well, hold on. I know that we are a big import country. We have a huge service economy. But if everything gets burned to the ground and has to be rebuilt back up, in some kind of a reset scenario, we have more of what the rest of the world needs than most other countries. Again, part of the reason that everybody thinks Russia is on the rise is because they have commodities that the rest of the world needs. Well, you know what? The U.S. has a lot of what the rest of the world needs as well. And that kind of gets overlooked.
I'm not saying that we don't export anything, but look, there are a lot of places in the world you can buy soybeans or wheat or corn. I think it's interesting.
Yeah, but hold on. Part of the reason that Japan can buy Brazilian soybeans is because the U.S. the hegemon of the U.S. protects the sea lanes that gets the soybeans from Brazil to Japan. You take that away and those exports don't get there as easily. Now, can they still get there? They can still get there, but it's not as easy, it's not as efficient, and it's not as cheap.
Well, you know what? When the dollar crashes and the U.S. is in trouble, maybe a lot of our aircraft carriers and battleships will be on the auction block, and some of these nations will be able to buy them and protect themselves. But when you talk about food, look, I don't know all the details on the food, but I know one statistic. The United States imports 90% of its seafood, 90%, which ought to show you how ridiculous it is. Here we are, a nation surrounded by oceans. We've got all these lakes. You figure we could fish, But we don't. We rely on the rest of the world for 90% of our seafood. So, it's not like, we're just feeding the whole world. We're not.
No. Hold on. This is what I think a lot of people get wrong. So it's not that I necessarily disagree with you, Peter. I think you're missing something, and perhaps you're not. But let me just explain something. Throughout history, whoever is in charge, whoever the big local power is, wherever the capital is, they always get goods from the hinterlands. Rome didn't export goods to northern Germany. The goods came from northern Germany down into Rome. That's how it's always worked.
Last time I looked, the Roman Empire wasn't that big anymore.
No, but okay. The other thing is, the reason that we import all this food or this seafood from other places is because we can. We don't have to. To your point, like if it goes back to a reset and we now have to feed ourselves seafood, we've got 3 oceans. We've got the Arctic Ocean, the Atlantic Ocean, and the Pacific Ocean.
Right, but how many Americans are willing to go fishing? I mean, do they even know how? I mean, they're going to be demanding free money from the government.
So what do all the people in China that make purses and shoes and cars, what do they go do? Do they have to learn how to fish as well?
They're a lot
Everybody
more
has to read.
But the Chinese aren't dependent. They're not a bunch of babies depending on the government. They're not looking for handouts like Americans.
Hold on. A communist China is not dependent upon the government.
Yeah, the average, yes, they don't have Social Security in China. They don't have, look, the Chinese work hard and save. Unfortunately, there's a lot more free market capitalism in China.
Guys, I think we're getting off topic because we're debating about the economy. So I want to focus on the U.S. dollar here. So let's just back up a little bit.
Okay, all right.
And I want to kind of think through this scenario of the United States going into recession, because I think we all agree that the probability is high that we see something like that in 2022 or 2023. So then we go into a recession. Let's say we do CARES Act 2.0, and then we run, instead of $5 trillion deficit, it goes up to a $10 trillion deficit. We do stimmy checks, we do PPP. My guess is that's what they would do to try to prop up the economy, especially if inflation, the headline CPI, was trending down. So Brent, in your argument, you say, okay, if the United States is doing that, then Japan, China, Europe, they're in a desperate situation where they would have to do more of that. And then Peter's point is that even if they did, that wouldn't necessarily tank their currencies, because they have this fundamental strength that they are an exporting nation. They produce more than they consume. And then your point was, well, that is true currently, but if the United States goes into recession, then that's going to take out their only customer, or one of their main customers. And I think you would also argue that then the United States is exporting fewer dollars to service global dollar-denominated debt, which makes demand for dollars outside of the United States increase significantly, the supply go down, even though we're seeing massive amounts of maybe consumer price inflation in the United States. So let's maybe try to start from there. If you want to just summarize that argument, I tried to put it in your words, but I'm sure you could do a lot better. Than maybe Peter can give a rebuttal to that specific argument, because I think that more pertains to what we might see over the next 6 months.
So I would do a combination of summarizing what you said and what Peter said earlier. If we went into a massive recession, everything that Peter is describing that would cause the dollar to fall is exactly what we saw 2 years ago. The US went into a massive recession. The government came out, lost their minds, spent however many trillions, sent out stimulus checks, did QE out of the wazoo. And initially the dollar fell. But look where we're at now. 2 years later, the rest of the world didn't, and the dollar fell 10%, 12%. The rest of the world did not take that opportunity to pay down their dollar debt when it was cheaper to do so. They actually took out more dollar debt. So dollar debt today is higher than it was 2 years ago. The world is more dependent on dollars today than it was 2 years ago. So I'm not saying that what Peter is forecasting can't happen in the short term, but unless the entire system is reset, it's just a matter of time until we end up right back where we are today. We were here in 2020. We were here in 2008. We were there again in 2011, 2018. We were there in 2020. Now it's 2022. Sure, we can have another round of this game where the dollar goes down to, I don't know, 95 or 92, and then 18 months from now we're back at 105 on the dollar. That can easily happen, but it's not going to solve the problem unless people actually and governments actually change. And I don't see the rest of the world and the other governments changing because they haven't done so.
Yeah, I think Brent's point there is you got so much dollar denominated debt outside the United States that creates demand for dollars. And if we export fewer dollars, because we go through a massive recession, we can't buy as much stuff, we can't import as much stuff, then those fewer dollars, then the other countries or the other corporations have to scramble for dollars. They have to sell their own currency, which in a relative world makes the dollar go up in value. And then, of course, what did we see in 2020? Why would 2022 or 2023 be any different? So do you want to address those specific topics?
Well, first of all, there's no question that our record trade deficits at some point have to come down. I mean, we got some trade data came out, I think, today, but it was better than expected, but still more than 100 billion on the month. I mean, these are horrific numbers. But even when the U.S. goes into recession, and if the dollar falls the way I think it will, yes, the volume of imports will come down. But maybe not the price, because as the dollar tanks, what we do import is going to cost a lot more to pay for.
A lot more dollars.
And so more dollars are going to have to go out. But also, we're not just a net, debtor when it comes to trade. We're a net debtor when it comes to a debtor nation. The world is holding a lot of U.S. debt, as you mentioned. And as interest rates go up, and they have already gone up, and this debt is rolled over, assuming foreigners want to roll it over, that is a bigger drain on the U.S. because we now have to send more dollars abroad to pay interest on all the debt that we owe to the rest of the world. So even if we're importing less because we're in a recession, our tab for what we owe based on all the stuff we already borrowed money to import, that is going up. So there are some very dangerous dynamics at play that push more and more dollars out there. But the question is, will there be demand for these dollars? Obviously, if the dollar is falling and U.S. dollar-denominated debt is losing value relative to other countries, there won't be that demand. I already think a lot of the demand that was there in the past is not there now. I mean, I think a lot of countries that were stockpiling dollars, if you go back to the 2008 financial crisis when we started QE and really started printing a lot of money, foreign central banks all around the world were gobbling up dollars. And one of the reasons they were doing it was because they didn't want their currencies to go up. They specifically, wanted to keep their currencies weak. It was like the currency wars.
Right.
And so, and I argued at the time, this was a mistake. They should have let the dollar go down. It was better than what they did. But I think at this point, I don't see, currency World War II, where all the rest of the world decides that, their standard of living is dependent on propping up the U.S. so they can keep selling stuff to a bunch of people who are broke and can't really afford to buy any of it. Better to let the dollar sink, their own currencies rise, and now their own people can afford to buy the products because now they have more purchasing power than the Americans, and so they can sell the products domestically rather than having to ship them all the way to the United States. So I think one of the main reasons that the dollar hasn't already collapsed, because obviously these problems aren't new, they're just bigger, right? But it's that the world has maintained its confidence in this system. They've had confidence in the Fed. I don't know why. I mean, the Fed has gotten everything wrong, yet for some reason, everybody still just assumes that these guys are geniuses. But I have a feeling that the number of errors they've just made, first in saying that there is no inflation, and then claiming that it's transitory, and then saying, well, don't worry, we're going to solve it because the economy has never been stronger and it can withstand the rate hikes. And then the next thing you know, we're in a massive recession and the Fed got that wrong again. And then the Fed has to go back to zero or more quantitative easing. I mean, that's going to be hard for the Fed to hold on to its credibility after that big a gaffe. we're probably already in recession. That's how blind the Fed is to economic reality. Because if you remember, the Great Recession, that was, following the financial crisis in 2008, that recession actually began in December of 2007. And when I was going on a lot of these TV shows in the summer of 2008, everybody was talking about how strong the economy was, how great the economy was, including the Fed. And when they would say, we would have the questions, is a recession coming? And most people would say, no, we might have a little slowdown, but no, we're not going to have a recession. And I was like, what are you talking about? We're probably already in a recession. I was the only one saying this on these networks. And the Fed was saying the same thing. No, we're probably going to avoid a recession. We were already in one. And we weren't just in any recession. We were in the worst recession since the Great Depression. And while we were in the middle of it, the Fed still couldn't see it and didn't even think we were going to be in one, let alone the fact we were already there. So it's very possible that they're already making the same mistake, that we're already in a recession right now. I mean, we just revised downward Q1 GDP to minus 1.5. So technically we're halfway there. We just need one more negative quarter. And, they didn't think Q1 was going to be negative, and it was, so they don't think this one is going to be negative. But look at what's happening. Look at the economic data. Look at all these retailers that are blowing up one after another. It's like another one bites the dust every day, the same old story. Customers are too broke to buy our products. They're spending all their money on food, energy, and rent. They've got nothing left over. I mean, how many companies have to come out and talk about how weak the consumer is? And you got Powell out there saying the consumer's in great shape, households are in great shape. And a lot of these companies that are missing on earnings, they're acknowledging they have a wage problem, they have too many workers, they need to get rid of their workers. Meanwhile, look at the segment of the economy that's hired a lot of people, all these tech, innovation, blockchain, all these companies that have gone public over the last couple of years that have losing money. They have a lot of workers. Those workers are going to lose their jobs because their employers don't have any money to pay them. Their business models don't work.
Yeah. So Peter, I think we all agree on what's happening domestically for sure. So I want to go back because if I could maybe try to summarize your argument there, it's the difference now, Brent, would be that the confidence in the Fed is going to be gone. We had confidence in the Fed maybe in 2008, maybe in 2020. Now that confidence is gone, and the globe is kind of, or the world is de-dollarizing, whether it's because of Russia, whether it's because of, just the fact that they don't want to continue to do business with the United States. Therefore, they're going to be settling in less of the transactions are going to be settled in dollars. Therefore, in the future, there's going to be less dollar debt created. And therefore, the dollar demand that we see right now globally is most likely going to go down. And that debt burden is going to be easier to handle once the dollar goes from 101 down to 90 or 85, something like that. So that's kind of the big difference. And I think that would be the pushback against that argument that you were articulating earlier. So what would be your response to what Peter was just saying?
Yeah. So I think that, so what Peter says, it makes a lot of sense. And the reason it makes a lot of sense is because Peter's a very smart, very rational, free market economist. Unfortunately, the people that run the world are not smart, they're not rational, and they don't believe in free markets. And so you have to factor that in. When you leave the domestic United States and travel to Europe or Asia, politicians don't suddenly get extremely smart. The central bankers in Frankfurt and Tokyo don't think differently than the central bankers in DC and New York. They all think the same way. So while what Peter says makes a lot of sense, they're just not going to do it. They're not.
So how does the politicians being stupid equal the amount of dollar demand being sustained or increasing in the future outside of the United States? Can you kind of explain that to the viewers?
So if I was running a shoe factory in Thailand, as an example, and I need funding, and I go to my banker and I say, I need $1 million. And he says, okay, you can issue a bond and you can denominate it in Thai baht and your interest rate will be 34%, or you can issue it in dollars and it'll be 6%.
Right.
Right? I mean, I'm making up numbers, but
right.
That's part of it. And then not only that, but me as a shoemaker, I have dollar revenues. I'm selling my shoes in dollars. So I kind of want to hold my debt in the same instrument that I'm exporting in so that I don't have to become a currency speculator all of a sudden, right? It's hedged. It's automatically hedged. So if I was a shoe manufacturer and I thought like Peter, and I thought this was all going to, go to hell, for lack of a better word, I could borrow in Thai baht or some other currency. The problem is it's very hard for me to do it. The central bank isn't going to support me. The government's probably not going to put policies in place that support me because because the people running that country are friends with the people running the other country, unless we devolve into some kind of war, which is very possible. And then the dollar goes up because of the crisis. So again, everything Peter says, the reason Peter sounds so smart is because he is smart. It makes total sense. If we were all living on an island doing this stuff for ourselves, which Peter and I kind of are, but it makes a lot of sense. But unfortunately, governments get involved and monetary authorities get involved. And the other thing I'll say is everybody thinks that the U.S. is making a mistake. The Fed is making a mistake raising rates. And I'm not going to argue that point. And I'm not going to argue the point that them raising rates is going to cause a recession. I think that they actually know that, to be honest. But I think they don't care right now because I think they think, and I might be wrong, but I think that they think that we can withstand higher rates better than the rest of the world can. And this is a tool they're using to force other countries into submission, for lack of a better term, right?
Because they don't have the dollar. Because it makes the dollar
they don't have,
higher.
You basically, this is the other difference. This is the other difference between 2020 and now. In 2020, we kind of had this globally existential threat, right? This virus is out there. It knows no boundaries. It doesn't care what country you're in. It's trying to kill us. And that's the thesis anyway, right? And so in large part, the world came together, acted in unison, and cooperated to fight against this existential threat. Well, now I think not completely, but for the most part, COVID is starting to get into the rearview mirror, right? And not only that, we don't necessarily have the existential threat anymore, but now we've got a bifurcated world. We've got East versus West. There's so much division now. You've got Russia versus the West. You've got, tensions between China and the US. And we've got the two supply chains now. The likelihood of coming together in a unified reaction, I think, is dramatically reduced. And nothing's impossible. Of course, it can happen. But I think the likelihood of the world working in unison is dramatically diminished. And so I just don't think, I think because sides are being chosen and lines are being drawn, I think the US is trying to shore up its side of the team, for lack of a better word. And if anybody's on the edge, they're going to put them in a position where they're going to have to.
I don't think
Peter,
the US.
Let's address specifically what Brent was saying about the future demand for dollars outside the United States because of that dollar liquidity. It's very easy to get dollar denominated debt, and it's a lot cheaper than maybe getting it in your local currency. And then that 70% of the transactions globally roughly are settled in dollars. So how do we de-dollarize and reduce dollar demand in that world?
Yeah, well, first of all, look, obviously, if I am a foreign shoe manufacturer, if I think the dollar is going to go down, then I want to borrow dollars because when I repay them back, they won't be worth as much. I want to do that. The world, when you borrow in a currency, you're hoping that currency loses value so that when you pay it back, it's less. The problem is going to be the lenders. See, right now, people want to loan US dollars because they have confidence in the dollar. Well, what happens when they lose that confidence? It's going to be the lenders that don't want to make dollar loans. People are always going to want to borrow in a currency they think is going to go down. They're just not going to want to lend in it. And that's going to be a big problem for the US government because we are the world's biggest borrower. We have to borrow from everybody. And if people don't want to lend to us, and I don't think they will, not at an interest rate that we can afford to pay, more and more of our enormous deficits are going to be financed by the Fed. The Fed's going to have no choice, politically speaking, but to crank up the printing presses. So for all this talk about quantitative tightening, they are getting ready for another round of quantitative easing because that is the only way to politically finance $3 trillion deficits or whatever they are. I mean, and we have these huge deficits. Supposedly we have this great economy and we still have $3 trillion deficits. Where are they going to go in the next recession? 5 trillion, 6 trillion? And where is the government going to get all that money? They're not going to raise taxes on the middle class. They're not going to cut Social Security or Medicare. So the Fed is going to have to print up all that money. We're going to have to print far more money in the future than we have in the past. And we're not going to get foreign central banks to do our dirty work. The Japanese, the Chinese, the Saudis, whoever, they are not going to buy up U.S. treasuries. The Fed is going to be the buyer of only resort. They're not going to want them. They're not going to buy them.
They're not going to want them, but they're going to be forced to buy them.
Who's going to force them?
The United States.
How?
With
At gunpoint?
Yes.
No, we're going to tell the Chinese we're going to launch we're going to launch war. We're going to attack you if you don't buy our bond. We're not going to do that.
We're not?
No.
How do you know that?
Well, look, our leaders are stupid, but they're not
exactly.
And you said
they have a plan.
Look, you said they have
leaders, our leaders aren't insane.
You said that
our leaders are insane.
They have this diabolical scheme, with the higher rate. They don't have a scheme. They're just kicking the can down the road. They are just desperately trying to do anything they can to postpone the day of reckoning. That's all it's about.
What are they doing? Okay, fair enough. Let's pretend I agree with you. What are they doing in Frankfurt and what are they doing in Tokyo?
Well, right now they're still printing money and they're still keeping interest rates too low.
So what's going to make them change?
Because I think they're still able to get away with the transitory narrative. They're still saying that what we're seeing is COVID related, it's Putin related, and so they're acting as if nothing has changed. But there is a point in time where the public is not going to buy those excuses anymore. And you still have some old school central bankers in Germany in the Bundesbank. These guys, they just can't keep quiet and watch the euro become the Portuguese, escudo or the Italian lira. It's supposed to be the Deutschmark. So at some point, something is going to have to change there. And look, the Japanese have a lot of savings on the line. They can't destroy the value.
They're going to need it. They're going to need it.
Look, they're going to have to, let rates go up. And let the bubbles pop, let businesses fail. Hey, look, it's even better. Force Japan to restructure its debt. I mean, default is better than hyperinflation. And some countries will be able to do that. I mean, countries, can restructure their debt. The Japanese borrowed way too much money, the Japanese government. I mean, so they got to deal with it. Either we have to raise taxes or, we got to slash spending, we got to default, we got to do something. But it's better than destroying your currency. That doesn't work in Argentina or, Zimbabwe or there's all kinds of countries that have,
it is better. Currency. It is better if you're a free market economist. It's not better if you're a Keynesian central banker.
Yeah.
So they're not going to do.
Yeah, the debt jubilee is what gets interesting with Japan.
Well, but look, guys, if all the world's currencies get wiped out and they all go to zero, then again, it goes down to who has the structurally better economy. And it's the countries that are more productive, that have the capital, that have the plant and equipment, that have the trained workers, that can actually produce stuff. We specialize in consuming stuff, but I mean, anybody could do that.
Yeah, so it's a great point, guys. We're running a little low on time. So Peter, I want to just back up and kind of tie up a loose end. And we talked about the dollar liquidity, and you made a great point that the banks aren't going to want to lend in dollars. But what if the global transactions are still settled in dollars and that shoemaker needs, let's just say they need natural gas or oil or something to make the soles of the shoes, and they still need dollars to buy their inputs for their shoes, these commodities that are settled in dollars. They're still going to have to go to some bank out there that's willing to lend them the dollars they need to buy the stuff, because that's how they settle. So how do we, and that creates the whole system, that creates demand, that creates the whole lending.
I don't think there'll be a shortage of dollars. I think we're going to be flooding the world with dollars. But I do think that as the dollar really destabilizes, a lot of these products are no longer going to be priced in dollars because the dollar will be too weak. I mean, prices will be going up on a daily basis if you try to quote them all in dollars. So, if the dollar is a stable currency, then that works. But if the dollar is in free fall, everybody's going to have to walk away from dollars and start trading in their own currencies, or maybe, pricing stuff in gold instead. I mean, using that as a benchmark, something that, can be stable across currencies. So I see all of that going away at the same time. If the dollar
banks won't want to lend dollars, and that will start to settle in different types of currencies because there'll be a loss of confidence in the dollar. Brent, what do you have to say about that?
Eventually, there will be a loss of faith in the dollar. That will come after there's a loss of faith in the lira, after there's loss of faith in the real, after there's loss of faith in the yuan, after there's loss of faith in the yen, and after there's loss of faith in the euro. It will happen, but there will be a progression of the dominoes that fall. The global reserve currency is not going to be the first one to go into hyperinflation. It just doesn't work that way.
Well, we've never really had a global reserve currency that was backed by nothing. You look at...
That's not backed by nothing. Hold on. This is the other myth we need to dispel. I think it's very easy to say that it's backed by nothing. And from a redeemability
it's backed by U.S. Treasury.
Absolutely. It's backed by the productivity and the assets and the taxing ability of the U.S. government. And
but the U.S. government doesn't have the taxing ability because they can't raise taxes. Nobody will vote for the politicians who raise taxes.
Neither
and the people are broke.
But everybody else is in I agree with you.
No, they're not.
Everybody else is in the same.
Everybody can't be, because there's an other side of all these transactions. We are a huge debtor nation. That means other nations collectively are creditors. Somebody is loaning us all the money we're borrowing. Somebody is producing all the stuff we're consuming. So everybody is not in the same boat that we're in.
And you know what those people did? And you know what those people did? Those people that got all those dollars, you know what they did? They turned around and they loaned them to somebody else outside the United States. So now they have all this dollar debt on their own balance sheet. That's an asset. And if the rest of the world starts defaulting on their US dollar assets, they default on the rest of the world. They don't just default on the United States.
Well, yeah, I think anybody who's holding dollar assets is going to take a big hit. The dollar is going to lose value. I mean, all creditors in US dollars are going to lose. Yeah, but at the end of the day, the American economy is based on our ability to continue to export dollars to import all the rest of the stuff that we don't produce. And so the minute the dollar is no longer acceptable as at payment, we're in a lot of trouble.
I totally agree with you on that point. No. We actually agree 100% on that point. It's the length of time it takes to get to that point, I think, where we disagree.
Yeah, and
I just think we can get there pretty quickly if everything starts to unravel.
Yeah, so I think Peter's coming at this from a fundamental analysis of the domestic economies of each country involved. And then Brent, you're thinking that I guess we got a lot of cross currents here, and Peter thinks that cross current will overwhelm the global dollar monetary system cross current that you think is a little bit more powerful. And I think that's kind of where our differences are, or where your differences are. Yeah. But where you guys completely agree is pretty much on the fundamental analysis of the United States for sure. And then to a certain, maybe to a lesser degree, the fundamental analysis on the other major economies like Europe.
And, an important point is, up until now, Brent's been right. I mean, the problems that I'm talking about, these are not brand new. Again, I've been talking about them for a long, long time, yet the dollar continues to defy logic and the problems get bigger. So we just have much bigger trade deficits, much bigger budget deficits. Our economy is even more screwed up now than it was a decade ago, 2 decades ago, yet the dollar hasn't collapsed. But the longer we delay the collapse, the more screwed up our economy becomes, because we have even more of an opportunity to build on this bad foundation, to continue to create more service sector companies and jobs and allow the manufacturing to disintegrate. I mean, Donald Trump, when he ran for president, he said, look, we got to reindustrialize. These trade deficits are a disaster. We need to make America great again by making America produce again and manufacture. So he saw the problem, but did nothing to solve it. He actually got worse under his leadership, not better. So we haven't been able to fix this. We've been continuing to build on this bad foundation. And so now when we do get the dollar collapse, it's that much more difficult, to go back to a real economy, to convince a bunch of Americans that, they got to start working now. When they've, grown up with the idea that they don't have to work.
Yeah. So guys, let's do this. Let's conclude the.
Yeah. Okay.
Sure. Brent, one more thing, and then let's kind of wrap it up. And I'm going to wrap it up by having you guys tell the audience what it would take for you to change your view. So go ahead, Brent, and we'll get into that last segment.
I think, do you want me to answer that question now? What would?
No. Go ahead and say what you're going to say. Sorry for cutting you off.
No. The point I was going to make, and I've said this before, and I've said it many times. I don't know if Peter's ever heard me say it, but I know I've said it several times, and I really mean this. Is I think Peter is probably the best person in the world at explaining where we are eventually going to end up. I think he absolutely nails it. Okay.
Yep.
I think the difference between Peter and I is Peter kind of focuses on the inevitable and I focus on the more imminent. I'm not necessarily an imminent guy, but certainly a shorter time frame than Peter. And while I think it's extremely important to understand all the points that Peter's making for the long term, I think investors and asset allocators and people who are kind of paying attention to the world, I think it would be worth their while to sit back and think about, why hasn't the dollar collapsed yet? Right? Why does it keep getting stronger? And perhaps some of the points I'm making might have some basis in fact, right? Mm-hmm. Not guaranteed. There's no guarantee that I'm right or that I will be right. But the reality is the dollar, it just has not collapsed yet, right? It hasn't. No matter how you want to measure it, it's stronger than other currencies. And I think it's because there's some additional things going on in addition to the fundamental factors that Peter so perfectly points out.
Yeah. Right. Well said. Well said. So Peter, what would it take for you to change your view?
So first of all, the dollar hasn't collapsed yet, but it's been on the brink several times. I mean, it almost collapsed in 1987. It almost collapsed in 2008. So it's been, near death, and then it's, revived. And so the question is, the next time the dollar falls the way it did in 87 or 2008, what if it keeps falling? What if there isn't a miracle to save it? That's what my thought is that how can you press your luck? Because I agree with what Brent is saying in that I'm right inevitably, but the timetable is difficult to tell. What if the imminent threat, or not maybe a threat, is that the dollar goes up before it goes down, because in the long run, it's
cross currents at play, right?
But here's the thing. How do you know when you've arrived at the long run? Because you can always say it's a problem in the long run, it's a problem in the long run. So that means eventually you're in the long run, except when you're in the long run, you still don't know you're there, right? You still say the same thing. It's a problem eventually. So at some point, somebody who thinks it's a problem in the future is going to be surprised because they've arrived at the future, right? There is no more can caking, because I'm sure it's not going to be, we're going to get to the point where it's a crisis. And then all the people who have said, hey, it's only a problem in the long run, they're not going to suddenly say, yep, it's a problem right now. They're not going to know it's a problem until it's a crisis. So it's going to have to happen. So the question is, can we do it again? The enormity, knowing that every time we have to go back to QE, we have to do it bigger than the time before, and because the problem is so much bigger, right? We have a much bigger drug problem, so we need more drugs. Can the U.S. get away with it yet again, given how big the numbers already are, how large the deficits are, how large the Fed's balance sheet is, how screwed up the economy is? Can we up the ante again and expect the rest of the world, given all the problems that the rest of the world has, to finance it again, to step up to the plate and loan the U.S. enough money to let us get away with it one more time? I just don't want to make that bet. I realize, yes, that's the trend. We've been able to get away with it all this time. So let's, just roll the dice and assume that it happens again. But knowing that eventually it has to collapse, I would rather just say, you know what, I'm just going to prepare for the collapse. And if we get away with it one more time, well, I'll have to ride it out one more time. I've done it several times before, but I would rather be prepared for the end game, because that's the only thing I'm sure of. The path, it's difficult. What would get me to change my mind? I don't think I can change my mind, because I know I'm right. But it's possible that Brent is right, and that before the dollar crashes, it has another big rise.
Or what would make you change your mind just in the short term, I guess, maybe in the next 6 months or a year, to where you'd say, I know what's going to happen long term, but the dollar might go up to 105. Well,
I guess if it does, I guess if it does go way up, I'd have to say, I guess I was wrong about that. It went up, but it ran out of steam around 2000, around 105 on the dollar index is where it ran out of steam when it had that initial rally early in COVID before it sold off. And so now we kind of double topped up there. We're not at 120. We got up to 120 in 2000. If you remember that big dollar bull market, 2000, 2001, the dollar was higher on the dollar index than it is today. So we haven't come anywhere near where we were back then. And of course, if you look at where the dollar was in 1971, before we went off the gold standard, you got 360 yen for the dollar. It's not even close. The Swiss franc, you could buy the Swiss franc for 25 cents. It's now $1. So the dollar is nowhere near as strong as it was in 1970. And it's not as strong as it was in 2000. So it's going down. It's just been going down slowly. And it has big rallies on the way down. But at some point, I just think it's going to implode. And I think that is the next crisis. I know I've thought that way before, but I'm even more, convicted on that now, because every time we avoid a dollar crash, we just make the next one that much more inevitable, that much worse.
Do you think if the Fed can get, let's just hypothetically assume they can get up to 2%, do you think that would be bullish for the dollar short term?
Well, if they could get to 2%, and the economy hasn't imploded, then that would certainly be better for the dollar than if they can't get to 2% because the economy implodes and they have to cut. So I think it would be better for the dollar. The question is, will the dollar be higher if they do that, or just not much, much lower?
Right.
Because I do think there is, a high, given the enormity of our trade deficits and our fiscal position. I think there's only so much higher the dollar can go. I think it runs into a lot of problems. And I do think that a lot of the major holders of US dollars are net sellers. I think that if you're sitting on a pile of US government bonds and you look at a chart of US treasuries going back to the bull market that began in 1980 and that I think ended in 2020, and now you're staring at a multi-decade long major bear market in US bonds, and you're just sitting on a pile of low-yielding U.S. treasuries, you want out. And I also think that the fact that we have weaponized the dollar to the degree that we have, that we are, putting these sanctions on Russia, that we're threatening, if China does something with Taiwan, I think that we have created a reason, as if there weren't enough reasons, to diminish the dollars that these countries are holding. So I think that any real dollar strength is going to be met by selling. You have a lot of holders of dollars and U.S. treasuries that would take advantage of the strength to get out, because if they don't get out, they're going to take huge losses.
Okay, so Brent, what do you think? What would it take for you to maybe change your view short term?
Okay, so I think my answer, in order to make my answer to understood correctly, I'm going to have to, say something regarding what Peter said, and that's the last central banker to strengthen the dollar, to artificially strengthen the dollar, not artificially, but was Paul Volcker. The dollar was very weak in the late 70s. He came in and jacked up interest rates higher than anybody thought he would. And that's why the dollar got so strong in the 85 and 86 or 85. The reason the dollar fell so much in 85 or 87, whatever that, and then again in the late 90s and the early 2000s and 2008, was not because the dollar was headed lower on its own. It's because the central bank came in and artificially weakened it. The Plaza Accord was a thing to artificially weaken the dollar. What Greenspan did in the early 2000s was done to artificially weaken the dollar. What they did in QE after 2008 was to artificially weaken the dollar.
But then the central banks came in and rescued it, because the only way they got the dollar to stop falling was coordinated intervention. That's what stopped it from going down.
When was this?
That was it. Well, in 1987, the end of 87, when the stock market was crashing, you had major coordinated intervention to try to stop the dollar from falling.
That's because they artificially weakened it, and then they turned around and pulled it back up. But the Plaza Accord was meant to weaken the dollar.
Yes, I agree. That was in 85. Okay. And I agree with that.
So my answer to the question is, if the central bankers came out and proactively worked to reset the system prior to the dollar spike, which I think will force them to reset the system, then I will hold up my hand and say, you know what? These guys actually got ahead of it. They weren't reactionary. They were proactive. They reset the system ahead of time. Then I would just have to say, you know what? I didn't see that coming, and they did it. The other thing that if foreigners were to stop, and when I say stop, not just once, but consistently stop showing up at treasury auctions, which so far they are, and they no longer buy our treasuries, and at the same time, the Bank of Japan and the ECB stops monetizing 100% of sovereign issuance under their control, under their jurisdiction, and the rest of the world started selling dollars and issuing less dollar debt and being proactive to get out from underneath their dollar liabilities. Then I don't see them doing that. But if they did that, I would have to hold up my hand and say, you know what, I didn't expect that, and I got it wrong.
Right. Okay, guys, fantastic conversation here. I sure appreciate your time.
It's always great.
It was a great suggestion, Peter. I appreciate you calling me and setting this up. So guys, for my viewers who want to find out more about what you do, where can they go? Brent, let's start with you.
I got just at SantiagoCapital.com. There's a contact information there. I'm pretty active on Twitter. You can search Santiago Capital. You can YouTube it or Google Santiago Capital, Brent Johnson. There's plenty of links.
Okay. And Peter, how about you, buddy?
Well, Euro Pacific Asset Management, that's the company that I moved out here to Puerto Rico. So that's my asset management company. People want to have me manage money in separately managed accounts and all sorts of international strategies that are designed to do well, in a stagflationary environment, recession, inflation, which I think is what we've got. Also, I own a family of mutual funds, Euro Pacific mutual funds. People can buy my mutual funds anywhere. Schwab, Fidelity, any of these discount brokers. You can get into my funds and get out of U.S. assets and U.S. dollars. Also, if you want to get into gold, we both agree that gold is ultimately the winner when it comes to monetary assets. I don't look at gold as an investment. I look at it as money, and it's certainly superior to fiat currencies and fiat cryptocurrencies. A lot of people are going to find out the hard way with these cryptos. But Schiff Gold is where I recommend that people get some physical gold and silver. Don't forget about silver. I think silver is very cheap. And follow me on social media. Listen to my podcast, The Peter Schiff Show. I usually do 2-3 episodes per week. You can listen to Schiff Radio on my YouTube channel. Also follow me on social media. I am pretty active on Twitter as well. That's kind of my busiest platform. I generally tweet throughout the day. It's kind of how I get my thoughts out there. But I'm also on Instagram and Facebook, and I don't use those platforms quite as much. YouTube, of course, because that's where a lot of my podcasts are also hosted.
Yeah, well, guys, thanks a lot. I can't recommend your podcast enough, Peter. I listen to pretty much every single episode. And Brent, you're going to be at Rebel Capitalist Live in June. That's going to be awesome. Yeah. Peter, we got to get you to a Rebel Capitalist Live, buddy, and we can have this debate up on stage.
I can't be with you guys on stage. I have to do it remotely because I'm too short. Actually, I'm not too short. You guys are just.
That's true.
That's my problem. You guys are whatever, 6'6", 6'7". I forget how tall you are.
Oh, that's funny. So if we ever do this on stage, Brent, I'm gonna have to get some chairs where you and I are, like kid chairs for you and I.
We have to do it in my sunken living room, like that photograph.
Yeah.
Yeah. All right, guys, enjoy your day. Can't wait to do it again.
All right. Have a great weekend, guys.
Hello, fellow Rebel Capitalists. Do you enjoy watching these interviews I do for the Rebel Capitalist Show? Well, if so, you would absolutely love Rebel Capitalist Live. This is the conference I do twice per year, and we've had speakers like Robert Kiyosaki, Lynn Alden, Rick Rule, Jeff Snyder, and Dr. Ron Paul, just to name a few. So go to rebelcapitalistlive.com and check out the next event we have scheduled in Miami.